Hello and welcome to Thank God It's Friday, and as usual, once again we are in conversation with a guest who can guide us through all that is happening in the markets and also perhaps give us some guidance as to how we can deal with the expecting volatility going ahead, not only in the short term but also in the long term. Today we are in conversation with Anup Maheshwari. He is the Executive Vice President and Head of Equities at DSP BlackRock Investments. Thanks for joining us, Anup.
Thanks for having
me. And I'm going to start off with the similar question that everyone has on their minds, which is both the RBI and the Federal Reserve have given their expectation on interest rate trajectories going forward, at least in 2017. Based on that, how are you expecting fund flows to develop for India specifically?
So it's actually interesting because they're representing contrary trends. So interest rates in the US are rising and we're expecting interest rates here to be stable to hopefully lower as inflation comes down. So interestingly, it impacts the type of flow coming into the market. So from a foreign investment standpoint, it's actually a little negative as interest rates rise in the US. Money actually tends to flow away because it's more an indication of a pickup in the economy there.
Right.
And as far as India is concerned, for all of us as local investors, it's a great trend for interest rates to be heading down, considering it's normally very positive for financial assets, and particularly for equities. So I think this sort of slight conflict between domestic and offshore flows is something that we've got to get used to for a little while.
Anup, I believe the retail inflows via SIP still continue to remain strong, but what has the trend been like when it comes to Lumpsum investments, given the way the global events that have played out over the last 2 months, domestic events, plus you have the markets turning negative, giving negative returns. Has that really discouraged Lumpsum investments in any ways?
Well, so the good thing is if you just look at the SIP flow at the moment, it adds up to a potential growth of between 10 and 15% in total equity assets every year. And that's the amount of consistent flow. It definitely does tend to affect lump sum because people tend to go with the market, with the direction. My actual concern is it shouldn't affect SIPs because in the past sometimes even SIPs start getting affected if they don't deliver good returns over a 2-year period. And we're coming close to 2 years now where markets have been a bit flattish.
Right.
So SIPs we strongly believe is the best way of investing because you just keep using whatever market volatility is there in the short run. Eventually you get a bull market and it covers up for everything.
Right.
But it's very important to keep the SIP going, and that's the message we're trying to send out to all investors. Lump sums will keep coming and going, but if the SIP flow is steady, I think that both funds obviously benefit from that, but so will investors.
Right.
Given the global backdrop, how are you factoring in Trump's policies and the impact on dollar, and hence how does that impact your investment strategy in India?
Sure, I think the biggest one that's being talked about is the tax reform in the US. I think that's beginning to become the trend, in fact globally perhaps.
Yes.
Where if they do some fairly aggressive tax cuts in the US, I think other countries will also have to do something to stay competitive so that you can attract foreign direct investment.
Right.
So we've got a close eye on whether they manage to implement these tax changes.
Okay.
They will have the equivalent of some sort of import tax coming through as well. So we'll see what they will do, but the trend generally is for a little more protectionism and tax benefits locally, and that's something that we need to think about as well.
Right.
Which phase of the economic cycle would you say India is in right now? And even when it comes to markets, it doesn't seem like a bull phase, doesn't seem like a bear phase. So, what's your view around the economy and the outlook for the markets?
Yeah, it's clearly in consolidation mode. There isn't a very strong upward trend, and the downward trend sort of got arrested a few years ago. So I'd say it's just a very slow recovery. But our focus tends to be more on corporate earnings than GDP because at the end of the day, markets and GDP aren't perfectly correlated.
Right.
Markets are more correlated to earnings.
To earnings.
And earnings were still very depressed, even though our GDP numbers for the last 2 years weren't so bad.
Right.
And that's what we're really counting on. At some point, the earnings will inflect. And the biggest sectors which have been a drag on earnings, which are PSU banks and metals, these two sectors themselves have taken away about 10% of earnings growth in the last few years.
Right.
If they change, and we are expecting at least commodities now to start delivering better returns, then that can take your earnings growth back up to a more respectable level, which we were used to, the 15% plus type of range.
Right.
And I think that will be a stronger guide for markets than where the economy is really.
Okay, so you partially answered my next question. That has to do with earnings. But a lot of people out there in the market have said that they are looking at a delay in recovery of earnings by a quarter to two. Under that circumstance, have you revised your earnings estimates as well, and how long will it take?
Yeah, sure. I mean, this whole demonetization exercise obviously pushes things back a bit,
Right.
and will create a air pocket of growth for the next couple of quarters. But I think the system will finally adjust. We see this only as a temporary situation. It's not a permanent structural change, and therefore, to that extent, I think earnings will come back eventually. So whether it's FY18 or partly into FY19, we're not exactly clear, because only
Okay.
time will keep telling us as
Right.
we keep meeting companies. But the fact is, it's coming at some stage. It's very unlikely that you will see further earnings, corrections from here.
Right.
So people have already adjusted their earnings down post demonetization, and I think that's pretty much the scenario. And at some point, there will be upgrades.
Right. And so we're also looking at the union budget. What are you looking for in the union budget, and what, according to you, will be a good union budget?
Well, that's a good question, because I think expectations have gone up significantly post demonetization.
Yes.
In terms of everyone's hoping and talking about some sort of tax reform, tax adjustments, better tax compliance, etc. This government has been surprising us from time to time.
Right.
So
Yes. Absolutely.
I'm not so sure it's going to be exactly the way we're thinking, and as simple as that.
Yes.
But I've got to say, most of the steps they've taken have been very considered, thoughtful from a long-term perspective.
Right.
I think the focus is more on long-term growth, even at the cost of some short-term challenges. And as long as the budget stays on that course, I think it's a great thing. So we are hopeful that we will get some of these tax changes.
Right.
But we'll wait and see for the budget.
Okay. Moving on to investment themes. On one hand, you've had the domestic consumption related companies which have taken a beating because of the cash ban. On the other hand, you have companies having a larger global exposure, still having some sort of uncertainty looming around their earnings growth. So what I want to understand is, where are you finding more comfort right now, global or domestic players?
Well, it's a mix. It's a very bottom-up
Right.
sort of process. So generally, when we're looking at sectors or companies, the sort of top-down thought process that we run across is whether there is pricing power in a sector, and is that pricing power increasing or decreasing. Wherever we sense that pricing power is coming under pressure, we tend to go underweight or lower weight in a sector. And wherever pricing power is coming back, we tend to be a little more optimistic. So for instance, in the energy companies, we've been quite optimistic now for a couple of years. We still hold most of our positions. And we've seen that oil marketing companies have been allowed to pass on prices.
Right.
And that's what we would call pricing power effectively. So that's an interesting area. To some extent, banks, selectively, it's a very bottom-up process. But banking and financial services is a great long-term sector to invest into. We're hoping at some point IT revives. There is some improvement, as discretionary spend in the US starts picking up, as the economy starts coming back. It's quite logical that it will help the pricing power of some IT companies as well.
Right.
So it doesn't seem apparent today, but it's something we've got an eye out for. So you've got to pick and choose basically where there's pricing power, and it's pretty obvious actually when you run across sectors where the pricing pressure is and where the pricing power is.
Right. In a few of your funds, I've noticed, at least as of 30th of November, you had increased allocations in several chemicals and textile companies. So I'm not sure whether or not this was before or after demonetization, but I suspect that you are certainly looking very positively towards these sectors. What are the prospects? Can you tell us a little more about these companies?
Sure. So textiles and chemicals are two areas again we like a lot, and at a very top-down level, I think the big change that has occurred in the last 2-3 years is that China has become lesser and lesser competitive compared to India on a lot of the sectors that they used to dominate. So textiles and chemicals fit within that very strongly. So most of the Indian textile companies are now a lot more cost competitive. They have a very good barriers to entry in the form of some strong clients that they have in the export markets, particularly the US. If Europe opens up at some point, that's another great opportunity for them. The same for chemical companies. I think the basic point across both textiles and chemicals is these are both businesses that have fairly good return on capital ratios,
Right.
15% and above. They've got good growth now because China is withdrawing from the markets. They've got some decent managements available that you can buy into, and they're scalable businesses. So those criteria we find very interesting, that combination, and it seems like a decent runway. I mean, this is not something that will suddenly change in a year or two. This looks like a 3, 4, 5 year process, which is why we find both these areas as very interesting sectors to look at.
Right.
Anup, you said you don't really like to look at sectors where they're losing their pricing power. Then that's clearly something which looks like it's happening in the case of pharma companies. They're clearly losing pricing power. Plus, they've had these US FDA issues which continue to sort of delay the entire resolution process. At the same time, domestic market has started sort of becoming much better for them, and valuations have sort of come down to more reasonable levels. How are you approaching this space?
Sure. So pharma we've had a bit of a soft spot for a long period of time.
Okay.
It's been one of the biggest shareholder wealth creating sectors over long periods of time.
Yes.
You're absolutely right that this has been a big challenge for them, both pricing as well as regulatory challenges. The way we see this is the regulatory challenges are temporary. They will come through them in another 6 months, 1 year, whatever time frame, but these are all temporary issues because at the end of the day, Indian companies account for the bulk of generic exports to the US.
Right.
Right.
And if they want to keep prices of drugs down, they have no choice but to buy drugs from India.
Right.
So it's very critical to their system, their healthcare system, which is why they have to give the approvals eventually. So what will happen is as approvals come through on the plants, the regulatory approvals come through, there's also a big backlog of product approvals that will then start coming. So you will get volume growth coming back, but you're absolutely right on the pricing side. So we've got to again pick and choose our names there. But we just like the fact that it's a sector that's pretty much down and out at the moment, but it's got good economics, good management, and therefore whenever these regulatory challenges start going away,
Right.
I think valuations will come back a bit.
All right. Anup, what are the parameters that you generally look at to decide on the right time to exit an investment? Because that is also a very difficult decision to make.
Yeah, so it's the same pretty much as we buy stocks. So the criteria we look for typically is, again at a very broader level, the philosophy is looking for growth at reasonable price. I mean, that's the normal way we look at companies. India is a growth market, so you're always looking for companies that are growing above average, but are available at a reasonable valuation and have the right ingredients of management and economics. So it's when that thesis, I mean, if you do enough work when you buy a name, then the thing that will get you out of it or force you to sell is any change in one of these underlying phenomena, which
Right.
is either growth suddenly comes off a cliff, there's some development that you didn't anticipate, there's bad capital allocation, there's a change in management, senior management, and you're not very happy with the new management, for instance, or there is some regulation that comes in and affects their basic business economics. So typically if there's anything that comes and punctures your initial thesis of growth and ROE trend, that tends to make you rethink your position.
Right. Right. Well, actually, one more, philosophical related question,
Right.
and we know that you run the marathon, and I'm sure that will require some amount of preparation as well. But what parallels do you draw while running in the marathon and investing in stocks?
So it's a very common phenomena of comparing the market to being a marathon and not a sprint.
Yeah. Yeah.
And I think just learnings from running a half marathon actually. But when you need to plan the entire journey,
Right.
it's you can't necessarily just plan for a small period of time.
Right.
And I think investments also, you've got to think through a full checklist of things that you want from a company, and ideally plan to hold it through this whole thesis playing itself out, and not get too swayed by what happens in the very short run. So easier said than done.
Right.
There's a lot of noise in our market which tends to keep pulling and putting pressure on everybody. Everyone's a human. But I think we've seen our best investments are ones that we've just sat through all the short-term noise and just had a bit of that long-term marathon approach
Right.
of where the business is finally heading, and just planning through it and building your position right through. So markets are a marathon, not a sprint. I think that's very clear.
Right. Right.
And we keep reminding investors of that factor.
we're also looking at a new year, and with New Year's, I'm sure there are a lot of people out there who take up new hobbies. And you have told us about something that you've taken up for at least a year, that's pistol shooting. Can you tell us a little more about that and why it's such a good sport?
Yeah, well, first of all, it's only a weekend sport, so it's easy to
Right.
do. And the whole idea was that, so I'd heard that, when you're aiming pistols, you've got to be very concentrated.
Right.
And that tends to help. So my son actually was very keen that he learns this sport, and then I joined up with him, and so both of us have been learning it. And I think the concentration that is required around pistol shooting is really very very useful to learn in your day-to-day life.
Right.
It helps in investing. Yeah, and a lot of these little outside activities I think are required for you to just become a better investor over time.
Right. Right.
Because they all add some value or the other. So I think concentration, keeping on track, again, it's about not diverting your mind, and hopefully makes me a better investor at some point.
Yes, absolutely.
All right.
Yeah, and
So
actually we
you have one more
should
question?
we should get your outlook for 2017 on the stock markets.
Sure. So you never catch a fund manager being bearish. I think they're always good. But I think the key for us, because we've had so many false starts in the last few years on earnings growth, we're very hopeful that FY18 is finally the year where we start getting it, because we've been like a stuck record expecting 15% growth every year the next year, but it's not been happening. So we're hoping that FY18 is the year for us,
Right.
where we do get some growth coming back,
Yeah.
thanks to tax reform or whatever comes through, and we see this period as just a small air pocket in that journey. But lower interest rates, very decent valuations. If earnings come through, I mean, there's no reason for markets not to be looking a lot better next year.
Right.
But would you really say FY18, or would it be a lot more, there would be a lot more conviction if you had to say that FY19 is going to be the better year? Because as you said, the the elusive earnings growth has sort of just continued to sort of elude investors, and plus now you will also have the GST which will come in, and it's believed to be a significant disruptor. So would you really stick your neck out and say FY18 or probably FY19 is something that you're really confident about?
Well, again, as the way I see it is, whether it's FY18 or 19, a year down the road I may be having the same chat with you of saying FY19.
Yeah.
But the fact is, as long as that growth's coming, and you're absolutely right, something like any new tax reform or legislation tends to disrupt the system in the near term. But eventually everybody knows it's a positive outcome.
Right.
So I think markets do tend to see through some of these issues eventually. So we're hoping that GST will most likely come somewhere between now and September, and it will create chaos for 6 months or so.
Right.
So you're jolly right in terms of saying that it might get delayed a bit from FY18 as well, possible. But we're hoping that the sectors that will turn earnings growth, which is commodities and PSU banks, aren't as impacted by GST.
Right.
Which is why we think to some extent you will get the earnings growth irrespective.
All right, so there you are with Anup's outlook on 2017 and how he's using his personal life experiences to help his investment decisions. But Anup, thank you so much once again for having us here. That's all for this week's edition of Thank God It's Friday. Happy holidays and stay tuned to Bloomberg Quint.